Hi guys, I'm Shadir. Today in this video we are going to look at why value investing is going to be a suck in 2026. Mainly we are going to look at the 5 reasons why we are going to be lose money even though we know value investing. The number one reason is fixed method. As long as we are using value investing over the decades, people are nowadays using value investing which promote the methods specifically based on fixed principles by filtering out based on the companies based on the growth rate and looking at the companies based on the fixed principle, those specific requirements meeting in those specific companies. Once it is meeting the specific requirements based on those specific rules, deciding that the company future is going to be bright in the near future in 5 to 10 years. This is not the guarantee way that you can say that any specific company is going to be successful in future. So the second reason is independent decisions. The main problem value investing sucks in these specifically in 2026 is because of the fixed method that you actually use to filter out the companies, that doesn't lead to the independent decisions. You fail to investigate and justify your own assumptions that why this specific company is going to be successful in futures. Most likely, for example, if we take KFC have 4,000 stores, and what I am expecting in next 5 years, they would most likely get 6,000 stores or 7,000 stores, and what is the current earnings now, and what they would likely to be reached in next 5 years, and what is the expected growth rate that I can look for independently with these specific companies, without our fundamental own independent assumptions and own understanding why the specific companies we are investing in, but blindly choosing the specific company based on the method that has been given by intelligent investors or any kind of books with the specific amount of rules and principles, that doesn't going to be guaranteed in every phenomena that guarantee return in the long run. So the third reason I'm looking at here is a long-term unsatisfied profits. So most people today facing are, they learn about value investing, they learn about different kind of valuations, about the intrinsic values and much more things. And people read the financial statements and look on those specific things, and they filter out the company based on the rules that has been mentioned in the value investing. But even though they filter out in the investigator audit, they go in long term, they face unsatisfied results and the companies go in negative mode, that the share prices go very highly drop and doesn't go much do better in the future. The specific reason is there is no specific guarantee that any companies who do in the past years who do well in past year will actually do great in future years. That doesn't guarantee any single percentage of things. So that's why always I recommended to understand any company independently based on your own assumptions to make a very important decision. Fourth things is the problem with value investing is never mind it. You have the concept and you have the principles and methods to filter out the companies and analyze the fundamentally and to understand and make those specific chartered companies to buy at the high level of margin of safety. But even though you have this specific method, those specific methods is not going to be helpful at all the way around to find the great companies. The reason specifically is it's not going to be working anymore is because there's a large amount of companies does not fit to these category areas. When you look for the 50% of the margin of safety, you could be able to find that 99% of the company don't trade under than 50% of the margin of safety. So you would waste a whole lifetime waiting for when the specific share price would drop below the 50% of the margin of safety, and you literally waste a whole life amount of time. So you have to be thinking independently what kind of things it's going on, what is the nature of the market has stand it out, what's the climate of the market. Based on that, you have to independently understand the companies, and you have to determine what is the best price that I can pay now, even though it is under the intrinsic value of 25%, and it is go down, or even though what the fair price that I can pay, so that even if it goes down, so I can keep buying. So that's the best strategy, that you have to be dependent on yourself, not on specifically fixed rules and strategic method. And the third and the final thing that I would like to define here is searching for the new method. Even though you realize the value investing sucks, the main thing you don't realize is, okay, value investing sucks, so what I can do now? it's better to search for the new method. That's the probably one thing that most people get into the trap. The harsh truth is no specific method or strategy, fixed strategy is not going, it's going to be help you over time. You just have to understand the market independently. Why you are buying these specific shares, what kind of shares you are buying, what type of shares you are buying, and more importantly, what is the amount of voting I have for the specific shares. And then these specific companies come to the IPOs, and how much data I can have to have them make a more informed decision, how I can believe on this specific company, about the CEOs and how they, how about the management, how they performance. So you have to understand every deep very information to make very clear decisions to bet on the highest uncertainty towards the future. So even though if you search for a new method, that's the one of the worstest way that you are doing, that you already wasted so much amount of years in using a value method. For example, if the key is to know the value investments and you become a billionaire, then why not you can become a billionaire? Like same if you invest for 50 years, because Warren Buffett have this different role and you also have a different role. But the matter of the subject is you have to understand the market completely for yourself, and based on its nature, you have to find the opportunity and you have to neglect the opportunity, and you have to find exactly where to put the money so that you can make a more larger amount of return over time. If you take, if you look at the Warren Buffett video specifically, that mainly Warren Buffett talk about mostly about Coca-Cola's and American Express and Wells Fargo. Lots of mainly more popular companies that he invested in specifically. But the main important thing is he buy the companies at the very lower prices. He said and lots of things he give the information. But if you look at his behavior, he most likely buy at Burgundy on 5% return on invested equities. So that most likely have the lesser growth rate, as well as he have the more tested on, and nearly he also buy the gold. So his investing there is completely different. What other people believe the value investing is going to make them rich. So the main important thing is you have to think independently. You have to learn and understand the market, and after that you have to understand and know how to find the opportunity and where the opportunities lies on. By factually you have to make the decisions to make an investment instead of blindly believing on the specific rules that specific numbers are seen in the financial statements, because that certain company is meeting those specific requirements, that specific company is going to be get very high in the future. Thank you. So this is the video is over. Thank you. Let's see you the next time. Bye.